All. On behalf of Philip Capital, I welcome you all to V-Guard Industries Q1 FY20 earnings call. The management is represented by Mr. Mithun Chittalapalli, Managing Director, Mr. Ramachandran V, Director, Chief Operating Officer, and Mr. Sudarshan Kasturi, Senior Vice President and CFO. So without taking much of time, I'll hand over the floor to the management for their opening remarks, post which we will open the floor for Q&A. Over to you, sir. Thanks.
Thank you, Deepak Agarwal and Philip Capital for hosting this call. I would like to start with a small opening remark. A very warm welcome to everyone present, and thank you very much for joining us today to discuss the operating and financial performance of our company for the first quarter ended 30th June 2019. We have made a steady start to the year. Top line grew over 10% to 699 crores. EBITDA grew over 56% to 78 crores and PAT grew over 52% to 53 crores in Q1 FY20. After adjusting for higher A&P in the base year, the EBITDA growth is 28%. During the quarter, the company has applied Ind AS 116 leases applicable from 1st April 2019. The impact on the financial results for the 3 months ended June 30th, 2019 is not material. We are making good progress in the non-South markets, which delivered 14% growth. We plan to further extend our new products into more non-South markets during the year. Non-South contributed to 46% of revenues in Q1 FY20 as compared to 44% a year ago. South markets recorded a steady growth of 7.1% during the quarter. The electronics and consumer durable segment performed well during the quarter under review, recording growth of 18% and 15% respectively. We have also been able to drive margin expansion across both segments. The electrical segments reported subdued growth of 1% in Q1 FY20, impacted by temporary destocking of wires by the trade on account of volatility in copper prices. Despite this, we have been able to drive overall gross margin expansion of 220 basis points YOY to 32.6%, while EBITDA margins stood at 11.1% in Q1 FY20 as compared to 7.8% in Q1 FY19. Ad promotional expenditures stood at 4.7% of sales in Q1 FY20 as compared to 6.4% in Q1 FY19. The base year had higher spends on some spillover from the brand rejuvenation and rebranding exercise launched in Q4 of FY18. Another key highlight of the quarter has been the working capital efficiency we have been able to drive, which has resulted in robust cash flows to the tune of 183 crore, higher by 137% as compared to 77 crore at the end of Q1 of FY19. Our prudent approach and focus on profitable and sustainable growth has resulted in an 11-day improvement in our working capital cycle, which now stands at only 51 days. This has further strengthened our balance sheet with a net cash position of 325 crores. Our return ratios continue to be robust, with ROE and ROC of 19.2% and 22.9% respectively on a trailing 12-month basis at the end of Q1 of FY20. Overall, we are happy with the progress we are making in our new categories and new markets. As a part of our transformational future-led journey, we are also moving towards becoming a deeper product capability-driven organization with innovation, quality and cost efficiency as key levers of competitiveness. Our enhanced manufacturing strength and brand visibility will also help further scale up our business proposition and consumer connect. Sustained and focused expansion into the non-South markets backed by continued investment in enhancing our organizational capabilities will further improve our competitive edge. On that note, I would like to thank you once again for your participation and would like to hand over the floor to the moderator for Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Renu Baid from IIFL. Please go ahead.
Hello.
Hello. Good afternoon.
Yeah, good afternoon, sir. So my first question would be, as in overall, what have been your feedback on the market sentiments and the growth outlook, given that we have been hearing few pockets of worry in terms of the credit tightness and NBFC issue, and some consumer companies have also highlighted signs of slowing consumption. So have you seen any of these factors affecting our growth outlook, or the channel feedback going forward looks a bit difficult? Your views on them?
So I think there has been some slowness in the market, and this is not, something that is very recent. It has been going on for at least 6 quarters. So I think in our case, at least it is part of our base. So that is why, we are able to post some growth.
Okay.
Also, there are a couple of products, some of our products, at least 40-50% of our products in our portfolio are weather related. So
Correct.
Definitely their sales, the weather has a much more larger say than, NBFC financing them or, stuff like that. So last year, for example, even if, there was no credit crunch, we still did not get any sale because the summer was pretty bad. This year, with the summer really firing, and especially some parts of the country, the sales have really picked up. So that's the, crux of the thing.
But at the channel level, especially dealer-distributor stocking, has those level of stocking been impacted because of the liquidity tightness in the system, or still is not seeing the impact?
So the answer is the same. Distributors and dealers of products like fans, voltage stabilizers, pumps, inverters and batteries, they don't have any much inventory left after the season because everything has been sold out. The other products which are not seasonal, yes, there is some inventory build-up and all that, but we felt that maybe in Q2 of last year, and we have taken corrective action. And I don't think today, at least our channel is not very much stuffed because we are, like you can see from our working capital, our debtors have actually come down.
Yeah, that's been pretty impressive improvement on working capital side. So my second question is, in wires and cables, obviously there's been a realization drop. So overall, in that category, as in how has the performance been from a volume and a value perspective in terms of growth? And overall, we have taken some price hikes. So for this quarter, what percentage of the growth could be driven by price increases and rest being volume?
So I think price increases on an average is in the range of 2% across the board. It varies from category to category, but on average you can take about 2%, that would have happened. In the case of wire, it probably is the reverse. So in fact, there is a decrease in prices, starting from April. So I think in the case of wires, if you compare with last year Q1, probably effectively there is no increase in prices. The prices did go up in Q4, but it subsequently came down when the copper prices have come down.
Right. Sure. And so my last question is, in the core of flagship portfolio of electronics, we have seen a very impressive margin performance. So how should we read in terms of the drivers for the margins, and what proportion of this improvement in your view should be sustainable for the rest of the year?
Some of the margin improvement is because, we had a better mix given that the summer was very strong. And then one other factor, if you are looking at segment margins and seeing the improvement, the base year had a significantly higher A&P, so you need to factor that as well.
Okay, but otherwise broadly 14-15% margin you think could be?
There is gross margin improvement.
There is a gross margin improvement in electronics also. Maybe about 1.5%. 1.5 to 2%. Yeah.
Okay. But at least the gross margin improvement could be sustainable for the rest of the year.
I think we'll have to, we should not extrapolate Q1 into Q2. I think every quarter, because of the mix of the products, the gross margins will be different. So I think definitely, if you look at generally, if you compare with last year on a YOY basis, yes, YOY basis, yes, there will be some improvement in gross margin.
Sure. Thank you so much, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Prashant Kutti from Sundaram Mutual Fund. Please go ahead.
Hi. Thank you, sir. First question is on the, you said wire segment and cables. You said one of the reasons was destocking was there because of pricing. Was it only destocking, or in general were the sentiments weak over there as well? Because until the last quarter, the growth was fairly more reasonable in the cables and wire segment.
So in fact, the Q4 of last year, we had a very good growth in wires. I think in that quarter, especially starting from Jan and ending in March, there was a steady increase in copper prices. And then starting from April, there was a decrease in copper prices. So obviously, in Q4, I think some of our dealers and distributors would have upstocked, and reverse would have happened the following quarter. So because I think, see, whatever slowdown you are talking about and we're generally hearing in the news, this is not a new phenomenon, and it's been going on for at least, like I said, 4 to 5 quarters for us. So all this slowdown, construction slowdown, everything has been going on. Maybe there would have been a slight impact of elections in the month of April. So some markets were disturbed because cash flow was not happening or cash rotation was not happening, and generally construction activities were slow in 1 month. But I can't say that for the entire quarter.
Just to add one more thing, right? As Mithun already said, we were hit, earlier, and we were hit last year, Q2, Q3, even some part of Q4. We could already see the impact of this slowdown, and we focused on collections in many places. Yeah? So I think the pipeline inventory for us is reasonably clear now. And so, personally, we are not impacted. There may be issues, they may just materialize at different stage in the journey for different companies, depending on how early they identify and how early they correct.
And in the electronics business, sir, you highlighted that obviously it was a very good quarter in general because the season was favorable. Is it entirely due to the season which one should build in? Because you said you should not extrapolate these numbers. What would be a steady state number one can build into as far as electronic segment is concerned now?
So I think the electronic segment has grown, by about totally about 18% in Q1. Yeah. I think for the full year also we will probably grow at something like 13 to 15%. What I meant is we should not extrapolate the margins because the mix will change quarter to quarter.
Okay. No, the reason I specifically asked that is because last year was definitely one of the very bad year as far as, let's say, stabilizers was concerned. I'm just understanding what is changing in this year for us to, is it purely base, or is it because Q1 has started on a very strong note? Because you said it's a seasonal quarter, seasonality is a big factor over here. So why 13-15% is what I'm wondering.
So I think definitely, the impact of Q1 can only sustain so much. The rest of the quarters, seasonality does not play. We also, Q4 is again another big quarter for us, so we have to see. So if we do have a fairly warm summer in Q4, we could probably do higher, but it's too early for us to now sit and predict what is the kind of, weather pattern we will have in Q4. We have seen that last few years, the onset of summer is delayed. It only really starts by March, or even April in some cases.
Okay. And so last question is on the working capital side. You just highlighted that you're very tight in working capital, and even sequentially there's a sharp working capital improvement. Any reasons you'd like to highlight over here? And just a follow up to that, cash flow generation has been fairly strong. Any take on that front? What do we intend to do on that side?
Okay, go ahead.
A couple of things. One is that, we've had a good season. So it obviously has had a positive impact on inventory compared with previous year. So previous year season was not good. A lot of, what I would say, the margin improvement which we generated may have been tied up in inventory, which would have been slow to move out of our pipeline, and which has come through, which has got released as the season was better this year. So inventory reduction is one big driver. I think, also, we have cleaned up our collections also, so that has also helped. So these two factors have driven us. I think going forward, it will be, I think, maintained or, as per, previous trends. So this is a one-time bump up which has happened because of the favorable season and better collection, which was our focus in Q4 last year.
And on the cash?
So right now, yeah, cash position is something like around 300 plus crores, but this is will probably reduce a little bit over the next couple of quarters because we have some capex and all that, and there is of course there is various seasonality also. So what happens is in Q2 and Q3 there will be again a slight increase in inventory. As we have stated before, we are looking out for inorganic opportunities, and this provides us with very useful resource in terms to look at it, and this gives us a lot of confidence to go after those kind of opportunities. And I believe in the current environment, more and more such smaller regional players will come up for grabs.
Okay. Just one last point, sir. Any impact of Ind AS 116 on our numbers?
Yes, we have adopted Ind AS 116 starting from this quarter. Those numbers are built in, but the impact is very negligible.
At an EBITDA level?
It's about 1 crore at EBITDA level.
Okay, sure. Thank you very much, and all the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. If you have any further questions, you may come back for a follow-up. The next question is from the line of Ashish Poddar from Anand Rathi. Please go ahead.
Yeah, thanks for taking my question and congratulations for great set of results. So I have a few questions. So one is, we have not mentioned this time in the presentation about our outsourcing and in-house mix. Also, the product-wise sales are missing in the presentation. If you can help me out with that, those numbers.
So the outsourcing, continues to be around, 59-60 odd percent. And insourcing is about 40-41%. We have, for reasons of competitive intelligence, we have from this quarter onwards we won't be publishing product-wise numbers. However, if you require those kind of numbers, the same can be shared offline.
Okay, thank you so much. Again, a question on the margins. So from last 2 quarters, we are seeing the overall margins are above 10%. I know that Q4 and Q1 is a strong quarters for you. But overall, if we look at the full year margin for FY19 and before that FY18, it was in the range of 8 to 8.5%, and now we are above 10%. Do you think that 9.5 to 10% kind of margin raise is sustainable going forward, or you see this volatility will continue and going forward we will see again a margin going back to the 9% kind of level?
So I think good part of FY19 there was a lot of commodity and forex volatility. It seems to have settled down as far as we are concerned now. If we do not have a significant increase in commodity prices, and if we don't have a significant depreciation in rupee in the next few quarters, yes, I think the margins can be between 9.5% to 10%.
Okay. So that's the sustainable thing. On the consumer durable side, if you can throw some highlight on the product, the new launches, how are they doing? Any further plans in the next 6 months' time, and also if you can elaborate your capex plans in the next 1 to 2 years time frame.
Yeah, I think there is no significant update from last quarter as far as the new products are concerned. I think last quarter I think there is this question again on how air coolers had done, which is a category that we had got into recently. So I think we were slow to launch a new platform. Yeah, and therefore, it's early. We just, look forward to the coming season for a better outcome.
And your capex program, sir?
Capex session, you want to capex, we expect this year capex will be in the region of about 60 to 70 crores for the year.
For next 2 years?
Yeah, next year also will be somewhat similar.
Somewhat similar. Okay. Thank you so much.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity and congratulations on a great set of results. So my questions are more related to the overall strategy of the company. So from a medium-term perspective, could you please highlight which are the focus categories that you expect to grow to achieve, the top-line growth that we have talked about in the presentation as well as the margin expansion from here on? And are there going to, what kind of investments should we expect in these categories from here on?
So I think we can classify, our product categories into three. We have at least 5 categories which are about 200 odd crores, and they are, each contributing more than 10% each to our revenues. And they are probably the older categories, what we have. And they are probably going to grow at a, slightly slower pace than the average. Then we have some medium-sized categories like switchgear. We have categories like kitchen. These are all, nearing 100 crores, close to 100 crores of revenues as the current year. And they are going to grow slightly above, the company average. And then, of course, we have some new, babies that we have just launched, like, some part in kitchen appliances and wiring accessories, so like modular switches. Some of the kitchen appliances like gas stoves. We also have something like air coolers, which is a very recent launch. So these are going to be growing at very fast pace, probably doubling every year, till they reach a critical mass. So, so I think each of these products are at different life cycle point of in the company. Some are the established ones and driving, giving us the stability, and the others are providing us with the growth.
Sure. So when we spoke about, pursuing inorganic opportunities, ballpark, which category are we targeting out here? Definitely, I don't think it will be the mature categories that you would go on to. So it will be the newer ones that you have launched?
Yeah, basically, the acquisitions for us is fundamentally with the focus to acquire capability. Yeah, capability, maybe having a geographic access, and maybe having a product access. Yeah.
All right. So my second question is the progress that you have made in non-South. Could you highlight what is the gross margin of South and non-South, and how much has the differential narrowed down versus, say, 5 years back?
Say 5 years back, the gross margin difference would have been somewhere 4 to 5%. They have more or less now converged. The difference won't be more than 1.5% now.
Okay. So, and
that's more arising also from product mix.
So could you elaborate on this?
No, I'm saying that the kind of products they sell in the two markets, the categories that sell can also be different, and that may also drive, right? So if the volume of business from certain categories is more, which is having a lower margin profile, then the weighted average margin profile may be lower or higher. So most of the newer categories which we have launched, they have been, we've launched them in southern markets, yeah, and most of the new category, revenues, would be coming from that. And they are coming at a higher gross margin. So I'm just saying that there is a lens of product mix also involved in that.
So I think if some categories like wires, it is already I would say a single gross margin across the country because we follow a uniform price policy. Something like a stabilizer and water heater, etc., could have like this 1.5 to 2% fans, an inverter. They could have this kind of a difference. The newer categories, of course, they're primarily in South, so there is, maybe the difference is, maybe it's better to look at only South. So that's what he means. Product mix also contributes to this, but if you look at apple to apple comparison of pricing and gross margin, it could be 1.5 to 2% difference.
Got it, sir. So, and 2/3 of our distribution is already in the non-South market. So do we envisage to increase that more towards non-South, or we are good to go with the present distribution that we have in non-South?
In non-South, we may not specifically increase the number of channel partners and distributors very high. But of course, the number of retailers addition will be very high there. So we aim to increase retailer count by 3.5 to 4.5 thousand every year going forward. and that will be primarily happening in non-South. Maybe a part of it will happen in South for new categories.
Got it. So, and lastly on fans, how much portion of our portfolio would be premium fans?
So I think when we entered the fans category, maybe it was less than 10%. Today, I think we are at about around close to 25 to 30% is decorative segment, or premium segment.
All right, sir. That's it from my side. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Naveen Trivedi from HDFC Securities. Please go ahead.
Yeah, good afternoon everyone, and congratulations on the very strong numbers. So my question is on the stabilizer performance. If you can just give us an idea about how was the value and volume growth you have witnessed during the quarter, and also how much it was led by the RAC business.
See, I think so there are a couple of ways I can answer this. So first of all, last year if you see, so stabilizer has three subcategories: air conditioner stabilizers, television stabilizers, and refrigerator stabilizers. There are three main categories. Okay. So last year if you see, the air conditioner stabilizer sales were deeply impacted. Okay. So because of that, I would say the average realization per unit was lower than this year. For example, the air conditioner stabilizers have a much higher average price per SKU than the other two categories. This year it's changed. But if you ask me, apple to apple, if you are asking me about price increase and realization increase, it could be around 2 to 3%.
But how was the value and volume growth this quarter?
So it will not be right to look at that like I mentioned, because it will look very distorted. Because there is a huge increase in the sale of air conditioner stabilizers comparing to last year. Because of that, the value growth will be high and the volume growth will be low.
Okay, because this quarter... Hello?
Yeah, it may not give you the right picture just looking at an aggregate. You need to look at each category.
Okay, because what we have seen that this quarter REC has done well, while panel was like a mixed bag. So was trying to understand how much it is like driven by the air conditioner business first.
Yes, so exactly what I'm saying. So the air conditioner sales have been very good and television sales have been subdued. You have talked about exactly the kind of performance we have mirrored. So what has happened is the volume growth does not look very high, but the value growth is high because air conditioner stabilizers have a higher, value than the average price per SKU is at least 35 to 40% higher.
Okay. Because at the channel level, there were lots of confusion. What we found when we spoke to the dealers and distributors, and they were talking about since inverter ACs has picked up significantly, and people were thinking that it may not require stabilizer for that product. Have you also observed such kind of issues at your level also?
See, I don't see right now we are not giving the product-wise details. So if we can reach out to us, we will share this specific info offline. Okay.
Yeah. Thank you so much, sir, and all the best to you, sir.
I'll just make a comment. Our air conditioner stabilizer sales have been very, very strong. So that's the only thing I can talk.
Yeah. Thank you so much, sir.
Thank you. The next question is from the line of Prateek Singh from Haitong Securities. Please go ahead.
Hi, this is Rahul from Haitong. I've got two questions. One on the GUT acquisition that we had done. Do we intend to keep it as a separate entity or we intend to merge it subsequently?
See, I think for some time we intend to keep it as a separate entity because V-Guard accounts for only 50% of the business of that entity and 50% it caters to other consumers. So there is some merit in keeping an independent management team because we can run that business as an OEM for some time. But I think eventually it will be fully acquired as and when we believe that they are ready for integration.
Okay. And the second part of the same question is what is the peak revenue that GUTS can actually do?
See, I think today the revenue run rate is about 60 odd crores for guts. Out of that, 30 crores is purchased by V-Guard to be branded and sold as our product, and 30 crores is to other consumers. Okay.
Right.
I think if you look at their current capacity, they have 2 plants, and it can go, we can probably double of what they are producing, so it can probably go to a turnover level of about 120 crores. Post which we will have to make investments in new plants.
Okay, fair enough. Okay, that's very helpful. And the second question I had was, while, we're talking about, slowdown and, that's the kind of input that even we are getting from the channels and all, but at the same time, even the competitive intensity seems to be increasing, especially some of your peers are now looking at, or some of the peers are having big plans for the southern market. What are your thoughts on taking competition?
So I think, because we have a very dominant presence in South, and V-Guard has made some inroads into other markets. Definitely about 2 to 3 years back, there has been significant increase in competitive intensity in South. In fact, our margins in South have been under pressure for about 2 to 3 years right now. So whatever results you see is after all that has happened.
Correct. And I also see, your non-South actually has been going at a faster pace than South, at least in this particular quarter. So, is this because of competitive intensity, or this is generally that the market in South is actually growing in single digit?
No, I think there are two reasons. One is that our market position in South is very strong and very, very high. So obviously at that kind of a market share, every incremental, percentage point of market share will come at a very high cost, because we are probably catering to almost all the retail shops in this particular zone. So now, no one can obviously have 100% of the market. So for example, we have some market shares in some categories up to 25-35% in some markets. So going above that is not feasible. So that is one of the reasons, the market, the growth is coming in, single digits.
Okay, fair enough. Okay, thanks. That's all from my side. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Hitesh Tong from ICICI Direct. Please go ahead.
Hello, sir. Thanks for the opportunity. Sir, from the last few quarters, or say 4 or 5 quarters, we have been witnessing a very strong growth in the non-South market, which is largely, a northern part and in the eastern part. So I just wanted to know, are we gaining market share over there, and which are the top 3 products have contributing more in the top line?
So if you look at non-South, yes, we will be growing faster than the market, and we will be gaining share because we are a challenger brand in those markets. The top 3 products will be voltage stabilizers, inverters and batteries, wires and cables. These are the 3 large categories that we are growing there.
Okay. So, I mean, since you have already, spoken about the difference is shrinking now, that South and non-South margin, the difference between South and non-South region, the gross margin is shrinking now. So, given the fact that the competition intensity has been increasing, and you've been, deploying more towards, advertising expenditures and all. And do you think this 1.5% of gross margin difference would remain in a long term, or will it again, will non-South regions gross margin will be at par than the South? Will be par with South regions?
So progressively, we have, reduced the gap of, pricing and positioning between South and non-South over the last 6-7 years, and it's a journey, and it's an ongoing journey. But a slowdown like this and, the competitive intensity will obviously delay this process a little bit. But definitely our intention is to close this gap, slowly and surely going forward. So that will definitely happen. But the pace at which we want to do, it will probably, a little bit of delay could be there. But I think for the health of the business and all that, it is always better to have a uniform pricing policy across the country, because differential pricing also leads to material moving from one place to the other. Today, without check post and with GST, there is a free movement of goods from one part of the country to the other. So eventually we would like to go with a single price policy, and that's the right way to go.
Okay, sir. Thank you.
Thank you. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Hello, sir.
Yes, good afternoon.
Yeah, good afternoon. So, first of all, congratulations on great set of numbers. What I would like to understand is, if we look at, consumer side, definitely there's an increased slowdown worry which is across the board. And we had a very strong quarter because of the, seasonally driven products. But going forward, do you see the momentum to continue? And do you see any, other initiatives which you can take to mitigate if there is a, kind of weakness in the market? We are seeing, the other competitors getting more into B2B, B2G kind of, segments also to maintain the kind of growth rates which they've been doing. Yeah. So for full year, what could be our growth expectations and how we plan to achieve that?
I think, let me talk to you about our strategy and, what are we trying to do, right? So fundamentally, we will continue our focus to grow our market presence in non-South. And, as Mithun had said earlier, there is opportunity for us, to expand our distribution width, right, by participating in more retailers. Yeah. And also, improving the penetration of existing category among more retailers because the penetration may not be uniform. Some categories would have achieved much wider and broader penetration. The second thing that we are going to do is, we are going to focus on the, expansion into, adjacencies. Yeah. And there are categories that we have got into in the last 2-3 years where we've been in the capability building phase, which we will, gradually move to revenue extraction phase. Yeah. So capability building phase is fundamentally about, getting our product portfolio, testing our product mix, yeah, doing pilots, yeah, and, getting to understand the category dynamics, right? So I think that, there will be dividends that will come to us as, some of the categories that we have recently got into will scale up. So that's going to be our second focus, in terms of, driving growth. The third piece, is fundamentally going to be, we are going to continue to focus on, efficiency, right? At our size and scale, there is huge opportunity for us to be more efficient through better management of supply chain, sourcing, product architecture, and there are many such drivers, and we will continue to work on them so that we are able to find fuel for growth. So these are three things from a growth perspective, three drivers that we will be focusing on, right? I think as far as the numbers concerned, we would not like to give a view of how we will do over the next 3 years. Yeah.
Okay. And from margins perspective, now in terms of, the competition which was there in the earlier years versus now what is there, because everybody wants to expand into each of the other, segments. So why, we should be, reducing the A&P spend significantly? Does it, and our continuous, focus to expand into non-South? So you think that we'll be able to maintain our brand intensity with this 4.5% kind of a spending?
See, if you look at us, last many years, the average spend has been 3.5% to 4% for, last 6-7 years. Only during FY18 and FY19, when we had the brand relaunch, it went up to, 6.5%. So I think it was not that 6.5% new norm. It's just that it was a one-time expenditure. And I think we had mentioned that at the time when we did the spend also, this is going to have a lot of one-time expenditure. So I think 4.5% of sales, roughly it gives us about 120, 130 crores of spend money. I think for a brand of our size, that is more than sufficient with enough, fuel for us to spend in new markets as well. And I think we are still higher than, as a percentage of sales, we're probably higher than many of our peers.
Okay. And so lastly on this inorganic part, so in terms of any, broader view on the categories which we would be looking at, because we have already, built a lot of categories in-house, already which we are trying to scale up. So what could be the areas which we are trying to address?
So we are always looking at adjacencies. So we will keep looking at adjacencies. So we have a consumer durable channel. We have a electrical channel. So we always look at adjacencies in these categories. We will look at India-specific categories where there is some barrier to entry. We will look at categories where brand affinity is very high. So these are some of the things. I cannot mention. We will look at A category or B category, but we are in the space of kitchen. We are in the space of wiring accessories. We are in the space of many categories. So any of these things which comes with any of the qualities we talked about, we look at it.
Okay, so great. So thanks a lot for taking my questions. All the best for the future.
Thank you.
Thank you. The next question is from the line of Inderjeet Singh from Macquarie. Please go ahead.
Hey, hi, thanks for the opportunity. Can you just give me some breakup in terms of what is the retail outreach that we have in non-South and what is that in South? And the second related question would be, in at least with some of your mature retailer presence, is there a dramatic difference between throughput that you're currently getting in non-South versus South?
So, we would be in about 40,000 outlets across the country. Yeah, maybe about 40-45% of that will be in South and, the remaining in non-South. Yeah. This is broadly, category to category, the number may vary. Our breadth of offering in South is more, and also the depth of, the offtake is also more, which makes our, South business, contributing more as opposed to non-South.
Okay. Do you think there is a concern or there is a risk that that some of these retailer presence that we have created in non-South might not be very sticky, because from a retailer economics point of view, if our throughput is not very large, having to tie up working capital in multiple kind of OEMs might be difficult, or it will become difficult for us to kind of expand or the depth of our relationship, and they might only want to keep our very fast-moving products like stabilizer, where we are well known.
We haven't experienced this so far, and consistently, North-South has been growing much faster than South. So I think that should be evidence, of what I would say, to the contrary, at least at this stage. Yeah.
So I think I would like to also add that not only we have grown, we have improved margins, and we have reduced, working capital in that part of the country as well. So the quality of sales is far better than what it was 5-6 years back. I'm not saying there is no retailer attrition. Of course, there is retail attrition, and we are talking about close to 23 different states and territories. So not in all the 23 states we will be achieving the same success. Some places will work faster than the others. But as a basket, yes, it is significantly improving every year.
How many retailers in non-South we would have added in last 1 year?
So we add between 3,000 to 4,000 retailers every year. I would say about 65 to 70% of it is in non-South. So you can say about 2,500 odd retailers in non-South every year.
Got it. Thank you.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, thank you for the opportunity. Congratulations for the great performance. I just had a couple of questions. One was with respect to the distribution part of it, can you elaborate a bit with respect to South versus non-South, whether the sales through the distributor or dealer is mixed in terms of South and non-South?
See, because South is an older market and South is a larger market, the proportion of distributors sale is higher in South. Maybe 70% of or 65% of sale is, I would say close to 70% of sale is done through distributors. In non-South, that could be like something like 45 to 50% is done to the distributors and 50% is to wholesalers.
Got it.
Directly. And that also we do that because we have to invest, in market building. So, being present there and, directly servicing the retailers helps to build the, brand presence in the market.
Got it. The second question I had, if I see your commentary, you said you're maintaining a 15% growth for FY20. I was just curious, if I do a number, it implies about 23% growth for the rest of the year. So I was just wondering, what kind of categories do you think will drive this kind of a performance, and are we building a recovery in the overall macro environment when we are looking at this number?
So I think a couple of things. I think if you look at last year, post Q1, Q2 and Q3 our sales were really subdued. Like Q2 growth was something like 6% last year. So we also have to look at the base. So I think in last year H1 growth was very muted and H2 growth was higher. I think today we are at 10%, but I think Q2, Q3 growth will be definitely higher because of a lower base. Last year Kerala had significantly underperformed also in Q2 and Q3. So that also will get corrected. We actually had a very bad festival season in Kerala in Q2, which we are hoping to recover this year. So there are a bunch of these factors. Having said that, will we exactly reach 15? I don't know, but I think we are definitely targeting to do 15% growth. Last year we did 12. I seriously believe that it should be better than last year. So somewhere between 12 and 15, we will go.
Got it. And if I remember correctly, we have indicated in the past that we look at least 100 bits margin expansion at gross margin level year on year through the price increase or product mix. So the margin expansion has been extremely good for the first quarter, partly to do with the product mix. But are we still maintaining the 100 bits margin improvement guidance going forward?
Yeah, I think that will definitely happen. I mean, in the first quarter we had a much better gross margin expansion than other quarters. But if you look at the full year also, we should be targeting that margin expansion, and that will happen. That will happen because of generally the proportion of higher margin products is growing much faster. That is one, and then definitely we are taking pricing action wherever there is huge price discrepancies. The third is in every category we are constantly killing low margin SKUs and launching more differentiated higher margin SKUs. So that work is an ongoing work, and definitely that this year also that expansion will be there for the full year.
Great. That's all from my side. Thank you so much.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. The next question is from the line of Aditya Bhartiya from Investec. Please go ahead.
Hi, good afternoon, sir. So, in response to one of the questions, you mentioned that if volatility in commodity costs and foreign exchange is not too high, then you would aim to deliver 9.5 to 10% margins. Just wanted a clarification. This, again, we are speaking about EBITDA margins including other income, right?
Yeah.
Okay.
Yes.
Okay. And so, I recall that our digital UPS margins used to be lower until a couple of quarters back. While we were taking a few actions to kind of improve it, how's the progress been over there? And is it fair to assume that the healthy margins that we have posted in electronic segment would be mainly on account of stabilizers and not so much due to digital UPS?
Both the categories have inverter gross margins have also improved. It's basically in line with our plan.
Okay.
So the Q1 margin is better than what we would have planned. That's a function of the stabilizer mix.
Understood.
I think both have increased. It's just not only stabilizer, but even in the case of inverter business, there has been good improvement in margin. So it has happened for both the categories.
And we would consider this kind of an improvement to be sustainable?
I think definitely yes. On inverters, yes. On inverters, yes. Stabilizer, I think stabilizer margin also I think could be sustainable, because stabilizer, we have to understand that there are 3 different subcategories within stabilizer. So depending upon the sales mix of these 3, it can change. But yeah, but apple to apple, yes, we are hoping to maintain.
So product margin will be okay. Category margin is a function of product mix.
Understood. Perfect. So not only is room AC stabilizer a higher value item, but even margins over there are better.
Not really. Okay. So I think we have some product categories in RAC stabilizers which are high margin, because they are going to areas where there is a huge fluctuations in voltage. So those products are probably comparable to the other categories. But if you ask me, the television stabilizer margin wise could be the higher one, the highest one, not the, because air conditioner stabilizer is also a category where there is huge competition. So the margins are lower than the other 2 categories. But within that, this year what has happened is our sales have been more for the value-added products, not the basic economy products. So that is actually also helping.
Understood, sir. And so lastly, on competitive intensity in the pumps business, I mean, one of your competitors has been speaking about fairly strong growth in pumps business, especially the lower value-added pumps, the lower price point pumps, even in southern markets. While for us, it appears that pumps business has been a bit lukewarm for the last few quarters. What is really contributing to that?
So I think this year Q1 has been very strong for the pump business as well, because the same summer conditions and the reduction of water table and all that has triggered demand for pumps as well. So even without any price cuts or launching low price products, our growth has been very strong for pumps as well. Yeah.
So the weakness that we have seen in electricals is purely on account of wires business.
Yes, it is purely wires. There is no other category that is degrown there.
And over there, are you seeing signs of any improvement? And is it being caused by general economic weakness and liquidity constraints as well?
Yeah, I think in the case of cable, I think it's difficult to pinpoint the issue, whether what part is contributing by the slowdown and what part is contributing by the destocking. One thing is very clear: the slowdown did not start last quarter. So in Q4 we had reasonably good growth for wires. So I would assume that it's the destocking. And in Q2 our growth in wires was weak last year, and I think this year should be better.
Understood, sir. That's really helpful. Thanks a lot.
Thank you. The next question is from the line of Srinidhi Karlekar from HSBC. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on good set of numbers. Sir, I have a few questions on the stabilizers business. So firstly, sir, I want to understand how much of the stabilizers demand actually comes from the replacement demand and how much is driven by the new appliance purchase?
So I think it's a little bit difficult for us to, do that. But I think the average life cycle is about 8 to 10 years for a stabilizer. It is slightly higher than the replacement cycle is slightly higher than AC. So I mean it's really difficult for us to put a number on it here.
See, the most of the stabilizer demand is a has dependency on the primary product demand. Typically, what happens is the stabilizer has a longer, what I would say, life than the, primary product. So you might find that, televisions are, replaced faster. Even ACs are replaced, because of this, STAR program and all that. ACs are also replaced, at 5 to 7 years. So in these cases, it is in many instances people would typically continue to use the previous stabilizer over a longer period of time. So cycles are longer than the primary product.
Right. And sir, my second question is on an annual basis, has the stabilizer business mix changed much more in favor of ACs over last, say, 4-5 years? And do you think probably this trend will continue for next few years, because AC as a category is likely to grow faster than maybe refree and TV as well?
I think if you look at last 4-5 years on a longer horizon, there has not been a significant change. Air conditioner stabilizers as a category is the largest category. One, because air conditioner, almost 70% of the air conditioners sold in the country are sold with stabilizers. So as a market, it's the largest, and also its price is higher than the other two categories. So in that sense, it always will be higher. But generally, if you ask me, last 5 years, the mix has been more or less same. Maybe last 5 years, we have seen an increase in the LED TV stabilizer sales, to the total percentage of sales. But otherwise, because LED TV sales, I'm talking about 5 year view, has increased significantly in the last 5 years. Otherwise, there has not been any huge change.
Okay. Maybe LED is growing faster, that's why growth is coming in like television.
Correct.
Yeah, okay. And the last one, if I may, this sir, is the consumers' behavior in terms of purchasing stabilizer in cities like Delhi and Mumbai fundamentally different than rest of the India? I'm coming from the context that these two cities have a fundamentally very good, relatively better quality of power supply. Do you see that?
Yeah, so Mumbai traditionally, stabilizer demand is, negligible, and it has been the case for a long period of time. So place like Mumbai or Ahmedabad, where power is, not an issue. Delhi is mixed, and there is widespread use of stabilizers in Delhi. Yeah, less maybe even central Delhi has stabilizer usage. May not be as significant as in some of the rural markets, but definitely in Delhi there is use of in the deployment of stabilizers.
Fair enough, sir. Those were my questions, and all the very best.
Thank you. Thank you.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you. Just one follow-up question. So Q1 FY19, as you mentioned, there was a spillover of higher ad spend towards our brand revamp. Could we quantify as to how much was the extra amount sitting in Q1 FY19?
It was 10 crores, the one-off element.
All right.
Around 1.5%, yeah.
Yeah, that's it from my side, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Deepak Agarwal from Phillip Capital India Private Limited for closing comments.
Thanks. I would like to thank the management of V-Guard for giving us the opportunity to host this call, and also to all the participants for their presence. So I just want to check if you want to add any closing comment to this call.
No, we would like to thank, Phillip Capital for hosting this call, and thank you, Deepak. Thank you all.
Thank you, sir. Thanks a lot.
Thank you very much, sir.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.